Welcome everyone to today's webinar in the Government Contract Foundation series. This one is called Understanding Indirect Rates. I'm Rich Wilkinson. I'm a director in the Solutions Engineering group here at Unanet. And let's just run through real quickly what we'll be talking about today. I'm going to give you a very brief introduction to Unanet if you don't know us already. And then we're going to spend some time talking about the basics of indirect rates. We'll also talk about the traditional structures of indirect rates and why there has developed a convention around those structures. We'll talk about how to go about developing rates, and then we'll discuss a little bit about some trends that we're seeing in rates and some of the issues associated with the rates and those trends. And finally, we'll talk just briefly about indirect rates in Unanet. Unanet offers a software solution for government contractors that ranges from budgeting, planning, and forecasting all the way through to financials. It's a unique approach to that in the accounting world, at least, in that it is a single application, one technology stack, one database with one security model that covers all those functions and uses the data one time, enters the data one time, and then uses it throughout the application. We can not only manage the pipeline, do the revenue and cost and margin forecasting for the organization, but then down at the individual level, track timesheets and expense reports and all the things associated with those, calculate, display, and make available to not just the top level people, but every person in the organization, real-time analytics, key performance indicators, both graphically and in numerical displays. We do the billing, revenue recognition for the accountants, gap, invoicing, and all the special stuff that government contractors need. And then, of course, the traditional financial stuff, the general ledger, paying the vendors, paying employees, and collecting the money from our clients, of course. And finally, cost pools and indirect rates. It may be the last thing on this slide, but it's the thing we're going to talk about today. Very briefly, these are a few of our clients. You might recognize some names on here. We have a number of clients in the under 50 employee category. You find that even the smallest clients are able to use Unanet. It's intuitive and easy to implement for smaller customers, and yet you'll see at the bottom of the slide we have clients as large as General Dynamics, Telos, Information Innovators, the Woods Hole Oceanographic Institute, and this afternoon at the end of the day, something north of 18,000 subcontractor individuals will enter a timesheet into a Unanet instance at Leidos, where Leidos uses our software to track their subcontractor time and interfaces it with their primary accounting system. It's an incredibly scalable product. Okay, enough of the commercial. Let's talk about the basics of rates. When we talk about rates, we're talking about taking costs that can't be associated with a single job or a single cost objective, as the accountants refer to those things, and allocating them across the jobs that are associated with a client and are billable. To do that, we divide cost into two categories, direct costs and indirect cost. And this is pretty much straight out of the FAR. Direct costs are those attributable to a single contract or a few contracts where it's susceptible to being split among jobs that are going to be billed to a customer. In the accounting world, cost accounting at least, that's called a final cost objective, something that's going to be billed to a client. Those direct costs are usually either caused by that contract or contracts, or they benefit just those contracts or jobs. Indirect costs are those costs that can't be associated just with a job or a few jobs and need to be pooled or collected in a bucket and then later allocated across those final cost objectives or billable jobs. In order to do that allocation, it's really pretty simple. We just calculate a fraction and then express it as a percentage. The numerator of that fraction consists of the indirect costs that are going to be allocated. We refer to those costs as the pool or the pool costs. The denominator of that fraction consists of the related direct and sometimes other indirect costs that are going to be used as the allocation base. Here are a couple examples. In this organization, theoretical organization, we have fringe cost of $280,000. And we have labor cost, and that's all the labor in the company, by the way. It's our direct labor charged to jobs. It's our indirect labor charged to pools like overhead and G&A. It's any B&P, bid and proposal labor, or IR&D, independent research and development labor. It's all the labor that we spend in the company. And that's my denominator for the fraction. It's $1 million. If I take 280,000 and divide it by 1 million, and then express that as a percentage, I get a 28% fringe rate. It's pretty straightforward. It's also a fringe rate I'd like to have. It's a pretty nice, nicely low fringe rate. I could probably win with that rate. Overhead works the same way. If I have overhead cost of 400K, now here we're talking about different kinds of cost. Overhead cost are probably costs like occupancy, supervision, training, things like that. And I have direct labor charged to jobs of 800K. And when I divide those numbers out, I get a 50% overhead rate. Also a pretty good rate for an overhead rate that includes occupancy. And that's how the basics work. The components are supposed to be related. So there's supposed to be a relationship between the pool cost and the allocation base. The regulatory auditors like DCAA refer to that relationship as a causal beneficial relationship. Either the cost in the base caused the cost in the pool to be incurred, or the costs or people or jobs that comprise the allocation base benefit from the expenditures that are going into the pool. It's causal beneficial. Sometimes that relationship is nice and clear. It's really easy to see with fringes. If you have employees, they cause fringe cost. Sometimes the relationship is a little less clear. Sometimes it's a little bit of a stretch, but if you think about it, you can see there's either a cause or a benefit going on there. Sometimes the relationship is simply specified in the regulations. And we'll see one of those in a few minutes when we talk about general and administrative expenses, or the G&A pool. Let's dig a little bit deeper into some pools and base examples. Fringe benefit costs are probably the most common pool, the one that everybody is familiar with in one way or another. Those costs are usually pooled and allocated over a base consisting of total labor. Now, as I said before, some of that labor is in other pools, the overhead pool or the G&A pool. Some of it is in jobs that are going to be billed to customers. The labor in that allocation base, what we pay our employees, causes the fringe benefit cost. And those employees benefit from those fringe benefit costs. Now, some of those costs, like payroll taxes, it's pretty hard for me to see how I benefit from those payroll taxes that my employer pays, but there's definitely a causal relationship there. When my employer pays me, my employer incurs those payroll tax expenses. So there's definitely a causal relationship there. Paid absence expense, that one's a little easier. I see how I benefit from those things. I get paid when I have a holiday and don't work. I get paid when I'm sick and can't work. I get paid when I take a vacation. That's definitely a benefit. And those costs go into the fringe pool. And then there are health and welfare costs. Health insurance, the portion that my employer contributes to my 401k or my pension plan, other kinds of health and welfare costs, thrift plans, all the other stuff that goes into the fringe pool. And by the way, those three elements, payroll taxes, paid absence, and health and welfare cost, are roughly equal in terms of the proportion that's in the fringe pool. So if I have a 30%, for example, fringe rate, I would expect payroll taxes to be somewhere around 10 or 11%. And by the way, that's just about what they are in most states. I would expect paid absence to be about 9 or 10%. And if you have 10 holidays and 2 weeks vacation and maybe a week of sick leave, that's about it, what it turns out to be. And then health and welfare costs make up the balance, and that's usually somewhere in the neighborhood of 10, 11, 12%, something like that. By the way, most of those costs are also pure variable cost. If the labor goes down, the costs go down. If you pay an employee less, or if you pay your employees in total less, you incur less payroll taxes. If you have fewer employees, then your holiday, sick, and vacation expense goes down. The one place that's not a pure variable cost are health and welfare costs, because health insurance is about the same, whether that's a lower paid individual or a very highly paid individual. Health and welfare costs can also sometimes be counterintuitive. For example, you would expect a young, lower paid, someone just starting out employee to cost less, but in fact, those employees often have young families and they can cost more in terms of health insurance cost. Older employees, we know their health insurance premiums do cost more, but they also tend to make more. So the denominator in that fraction is higher. Like I said, sometimes it's counterintuitive. For each of the 3 tiers in the pool structure, I have a rule of thumb. And that's all it is. It's just a rule of thumb, but it's one that DCAA uses pretty much across the board. And here's the rule of thumb for fringe benefits. Cost in the fringe pool should arise out of the employment relationship and not out of business activities like doing work for clients or outcomes like making profit or not making profit. And it shouldn't arise out of running the business like business licenses or the president's salary, those kinds of things. So fringe pool comes from employment. And that brings us to our first poll. I said a minute ago that a 28% fringe rate was a pretty good one. I'd like to have that. And I used a 30% fringe rate when I talked about the components of fringe. We'd like to know, where does your fringe fall in these ranges? By the way, these polls are completely anonymous. Having said that, if you choose not to respond, that's okay too.
And Rich, the polls are coming in. I'll shut it down in a second.
All right. I will mention, by the way, we're going to do these polls very quickly. So just pick something and respond when we do one of these polls. There's several of them in here, and I don't want to spend a lot of time on them. So what do we have, Jess?
We have, so the question was, what is your primary or overall fringe rate? We had 30% or less was 29%. 36% was the next range, which was 31 to 35%. 16% said 36 to 40, and then 19% said 41% or more.
Interesting. So 2/3 of all of our respondents are below 35%. And that's kind of where I would expect it to be. By the way, that 41% or more, like I said, fringe benefits are sometimes counterintuitive. I'd be willing to bet that that was an employer with a lot of Service Contract Act or entry-level lower wage employees, and the fringe benefit costs for them tend to be higher as a percentage of salaries. Interesting.
Yep.
Okay, let's go to the next tier in the typical structure, and that's overhead. Overhead costs are usually allocated over a base consisting of direct and bid and proposal, or IR&D if you have it, labor. Sometimes called productive labor, or labor that's worked, okay? Notice here we're not talking about total labor anymore. So labor in the overhead pool doesn't get overhead cost. It can't be in both the pool and the base. G&A labor in general doesn't get overhead cost applied to it. The cost of that labor, supporting that labor, is actually in the G&A pool. B&P and IR&D, that's one of those things that's simply specified by the regulation. They have to be in the overhead base and take their fair share of overhead cost. Again, we have a causal beneficial relationship. The labor in the allocation base, labor that's been worked on a productive job of some sort, causes the cost in the overhead pool. And the kinds of costs we're talking about are supervision and training. Many times the supervisors will be in the overhead pool, sometimes not, sometimes they're direct. They can't be either or, okay? They're either one or the other as a matter of policy. Often IT costs are in the overhead pool because IT is seen and often is completely supporting direct work or work for clients. Incentives and morale cost are typically in the overhead pool. And I always get the question, why aren't morale costs in the fringe pool? And the answer is sometimes they are. That's one of those gray areas. It's a judgment call. If your morale costs are intended to boost the productivity of the workforce, there's an argument that says maybe those should be in the overhead pool. If they're simply to create camaraderie within the workforce, maybe they should be in the fringe benefit pool. That's one of those that could be either way. Incentives, on the other hand, that's an area that DCAA gets involved in fairly regularly. And I've fought this battle a number of times. I've won a few times and I've lost a few times. And here's the thing. If your incentives go to everyone, no matter what, you can probably put them in your fringe pool because there's something that benefit the entire workforce. If, on your other hand, your incentive plan is designed to reward people with good outcomes on work done for projects and not people with less attractive outcomes or poorer outcomes, then that's cost associated with doing work for clients. DCAA says that belongs in the overhead pool. So if your incentives are in the nature of not profit sharing, but simply a benefit to everyone, fringe pool. If they're in the nature of incentivizing more productive work, they really belong in the overhead pool, and that's DCAA's position, not necessarily mine. But like I said, I fought that battle a few times. When they're talking about productivity incentives, I've lost that battle more than I've won it, and they've ended up in the overhead pool. And of course, facilities expense, occupancy, the heat, the lights, the water, all the things that go to support people working in your facility, right down to the depreciation of the furniture and the pencils and the paper clips. Now, this tier has a rule of thumb too. In general, cost in the overhead pool should arise out of work done on projects. Those could be billable projects, they could be internal projects, but it's what's called productive work. So that's what goes in the overhead pool. And if you thought, gee, now's a good time for another poll, you're probably just about right. It's right after this slide. Sometimes, now this is not completely uniform, sometimes overhead costs are accumulated in two different pools based on where the labor's worked. Sometimes companies will have one pool for labor worked at the customer site where the customer is furnishing the heat and the lights and the water, and to some extent, even some of the supervision and the pencils and paper clips and the IT support, the desks and the chairs and that stuff. Occupancy costs. Labor worked on company sites, on the other hand, the company is paying for all of those things. Now, there are a couple issues with company site, customer site pools. Number one issue is I sometimes see companies split their pools too soon. The company is relatively small, and the bases in those two pools are so small that the pools become extraordinarily volatile. Somebody can take a vacation and 2 weeks of labor disappears out of the overhead base and the overhead rate goes up 3, 4, 5 points. So you don't want to split your pools while the company is too small and make those pools really volatile. The other thing I see happen sometimes is companies don't split their pools until they've grown quite large, and DCAA comes in and looks at it and says, wait a minute, you've got 50 or 75 or 100 people working on this Navy base or Air Force base, and the government's providing all of their occupancy cost, but they're in an overhead pool that allocates to them cost of people that work in your company site. That's not right. That's what DCAA refers to as a distortion of allocations to final cost objectives. And they will sometimes suggest, and you can't see my hands, but I'm making big air quotes around the word suggest, because when DCAA suggests that you need to create a new pool or split your pools into different pools, it's not really a suggestion. In fact, I had a client a few years ago when I was doing some compliance work for a CPA firm that experienced this suggestion on the part of DCAA, and they had to go back 3 years and split pools apart and revise billings and so forth. And some of the cost, of course, went up, some of the cost went down. Unfortunately, the cost that went down gave money back to the customer that the customer couldn't do anything with. And the cost that went up on cost type contracts, they sometimes didn't have any funding to cover. It was not a good experience. So it's something that needs to be monitored consistently as the company grows. And now we come to that poll I warned you about. What's your overhead rate? Now, if you have multiple rates, give me your company site rate. If you just have one, tell me where it falls. Jess, let's do this one quickly.
Will do.
Because there's another one right after it.
I know.
We'll kind of take a break.
Yep, so this one's kind of interesting. So we had 35% said 20 or less, 23% said 21 to 30%, and then 12% said 31 to 40%. And we had a couple stragglers. 30% said 41% or more.
30% of our respondents said 41% or more?
Yep.
Interesting. Now, it's probable that those people have a significant amount of occupancy cost. One of the things that's surprising is to see a single rate or a company site rate less than 20%. And that's a trend that I see in companies, not necessarily in pools, toward virtual companies where there really isn't much of a brick and mortar presence for the company. Their employees are have a virtual presence in terms of the company and don't work in a facility at all, customer or company. So if you have multiple rates, how about telling us what your government site rate is? I argued with them a little bit over the percentages here because 15% or less I didn't think was low enough. When I worked for a company 35 years ago that had a government site rate, our government site rate was 4%. It was extraordinarily low, and that was a winning rate even back then. So I'm not sure 15% is low enough to really categorize things. What do our respondents look like, Jess?
Let's see here. All right, so we have 64% said 15% or less, 20% said 16 to 20%, 2% said 21 to 25%, and then 13% said 26% or more.
Interesting.
So most of them ended up at the 15% or less.
So almost 2/3 of our respondents were 15% or less. And I'll bet you if we had 0 to 7 and 7 to 15, we'd find a significant chunk in that 0 to 7 category. Maybe we'll try that on a future poll.
It would be
someday.
interesting to look at.
So final tier of the traditional three-tier structure is G&A, general and administrative cost. And those are the costs for running the company. Now here's a pool where the base is specified by the regulation, sort of. Because if you're a small business, you can really use almost anything you want to for a G&A base. The problem is if you use something off the wall, something nobody else uses, very unusual, DCAA isn't going to understand it. And DCAA auditors have a fairly simple approach to life. If they don't understand it, they don't like it. And if they haven't seen it very often, they're probably not going to understand it. If you are large enough to be covered by what's called cost accounting standards, and that's a different presentation. But when you're covered by cost accounting standards, you no longer have a choice about your G&A base. You have three things to pick from. You can use total cost input. Total cost input says that anything that isn't in the G&A pool is in the G&A base, except for some statutory unallowable costs like federal income taxes and interest, and they're not in anything. Value added is your second choice. Value added is like total cost input, except that materials and subcontracts, and only those two things, materials, and we're not talking about ODCs here. We're talking about materials that are going to be used in a manufacturing process. Materials and subcontracts are excluded from the G&A base in a value added scenario. Instead, materials and subcontracts are usually in the base for a pool used to administer those relationships, usually called the SCMH, Subcontract and Material Handling Pool. There are a few companies that use what's called a single element. Now, single element often means single pool, not always, but sometimes. But it applies to a single element of cost. I typically see single element used by pure consulting organizations. I think I mentioned a little while ago, I used to work for a CPA firm. CPA firms often use single element as their G&A base. In fact, many CPA firms only have one pool. Everything is in it, and they use single element. And that single element is labor, because that's what they sell. As a result, if they have a subcontract, if they have an expense report for travel, if they have some kinds of materials or other non-labor cost, they don't mark it up at all. All of their indirect costs are allocated over one single cost element, which is labor. Now you should be expecting this because all the other tiers had one. There's a rule of thumb for G&A. Cost of the G&A pool should arise out of running the business and not really anything else. Writing proposals is part of running the business. It's part of revenue acquisition. The Office of the President, finance and accounting, business licenses, other kinds of taxes except for payroll taxes. Those are all cost of running the business. Legal expenses, the few legal expenses that are allowable would go in the G&A pool. Those are a cost of running the business. Business development is usually a cost of running the business. Those don't go in the overhead pool because they're not cost of doing work for clients. They're just the cost of maintaining the business structure itself. And I think this is the last. No, it's the next to the last poll. Just very quickly, tell us where your G&A falls in this category. Again, these responses are completely anonymous. Even so, it is completely up to you whether you choose to respond or not. Don't want you to do anything you're not comfortable with. What's it look like, Jess?
Well, we have 16%, 10% or less. We have 33% between 11 and 15, 20% between 16 and 20, and then 31% was 21% or more.
Interesting. I'll talk a little bit more about the G&A rate when I talk about how to build a rate structure and where do I want my rates to fall, because that's really interesting. I'll tell you why in a minute. Let's review those rules of thumbs. Rules of thumb, yeah. We've talked a little bit already about the fact that this is a 3-tier rate structure, and there's a causal beneficial relationship in each tier between the pool cost and the allocation basis. The rules of thumb are tier 1, fringe costs, arise solely from the employment relationship itself. Just having employees cause fringe cost. Overhead costs, all the cost in tier 2 of the rate structure, typically arise out of and provide support to work done for someone, for clients, or for the company in terms of bid and proposal and IR&D cost. G&A costs arise solely out of the cost of running the business, okay, including revenue acquisition. So, having said that, the 3-tier structure is not the only one. Single pool or single element, and as I said before, single element often means single pool, means that there's one rate applied to a single element of cost, and that pool contains all the indirect cost, and the base usually consists of labor, and it's all the labor charged to projects, and just projects. It's rarely used by companies of any size, except for, as I said, pure consultancies, companies like law firms, accounting firms, public relations firms. You will occasionally see it in creative firms, advertising, things like that. But not that much, because they tend to have significant non-labor costs. Accounting firms are a growth industry in government contracting right now because of the trouble DCAA's had in the last few years keeping up with their workload. The civilian agencies have started buying a lot of services from CPA firms to do audits they used to use DCAA for. As a result, we have a number of CPA firms, particularly in the Washington, D.C. area, that suddenly find themselves competing for government work and becoming much more like their clients, perhaps, than they have been in the past. It's a new area for them. I do see a number of 2-tier structures, and this is probably not as strange as you might think. By the way, the percentages here are from surveys that I've conducted myself in the past with another company, surveys that we've done in association with one of our partners. And the first one, the single element, is typically used by less than 1% of government contractors. The 2-tier structure, this one, is probably 5% or less. It certainly isn't a lot of companies. And the 2-tier structure really consists of just one pool for fringe and overhead. There still should be a separate pool for G&A, because remember, once we get to a certain size and cost accounting standards kick in, we're forced to use a particular base for G&A, and that wouldn't work for fringe and overhead. But because fringe and overhead often have the same allocation base, namely labor, you sometimes see companies that simply combine them all in one pool. If you had, from my previous example, a fringe rate of 28% and an overhead of 50%, and they were allocated over the same allocation base, you could simply add them together and say, I have a single indirect cost pool exclusive of G&A, and the rate is 78%. And that would work just fine. And that's where we typically see the 2-tier structure. Just about everybody else uses the 3-tier structure. And when I say just about everyone else, there might be 0.01% of government contractors that use something other than one of these 3 structures. It would probably be very small companies who are using something unusual and are simply flying below DCAA's radar. In all the companies I've worked, and especially here at Unanet, we love our government contractor clients. They are, every one of them, absolutely unique. But when it comes to accounting, they tend to be a lot alike. Why? Because the government forces us, all of us, into a single mold for how we do our cost accounting. And that's why that three-tier structure is so ubiquitous. Most of the three-tier structures have a pool for fringe, sometimes multiple pools, a pool for overhead, again, sometimes multiple pools. And the base for overhead is usually labor. It's sometimes labor plus fringe, and that can be problematic as you grow. We're not going to discuss that today. It's an advanced topic. There will be an issues in rates webinar sometime in the future, and we'll go into some detail on some of the interesting issues associated with rates, and we'll talk about it then, so watch for it. The third tier is typically a G&A pool with a base of either total cost input or value added. And these three-tier structures are popular with auditors simply because they see it all the time. They understand it. It's taught in the schools that they go to, whether it's an auditor school or a contracting officer school for pricing. And so they understand it, they like it. And when they like it, you have an easier time of things. So what's your structure? Let's see if we've got any outliers in today's group, Jess.
All right, I've just launched it, Rich.
Okay. Do you have a single pool, 2 tiers with a combined fringe and overhead, a 3-tier pool? Do you have a 3-tier pool with multiple fringes or multiple overheads? Or do you have something else, or frankly, just don't know what your company's using?
So Rich, we have an interesting spread here. So only 4% said that they had a single pool.
Okay.
14% said that they had 2-tier.
Mm-hmm.
A whopping 65% said that they had 3-tier. And 13% said 3 tiers with multiples. And then 3% said that they didn't know, or other.
So 65 and 13, 78% of our respondents had a 3-tier structure of some sort.
Yep.
Interesting, and pretty much what I expected. Frankly, I didn't expect to see that many 2-tier responses. All right. So, if that's all we did, that would be complicated enough, but there are sometimes reasons to make it even more complicated. We're going to stick to that 3-tier model, though. I tend to see fairly often these days multiple fringe pools. Sometimes it's based on geography, especially if health and welfare costs tend to be distorted between geographies. I often see multiple fringe pools based on employee classification. So I'll see sometimes a full fringe pool for the primary workforce. I'll see a reduced fringe pool, particularly around military bases, where there's a large pool of available labor consisting of retired military or retired civil service who already have a pension, already have health benefits, and are willing to take a reduced benefit plan for employment. I'll sometimes see another fringe pool strictly for Service Contract Act contract employees. Because the government specifies those rates, they can sometimes drive the fringe rate well up into the 40s. And if that was mixed with our other fringe pool, it might cause us to be not competitive on contracts where the Service Contract Act didn't apply. Multiple overheads are very common. Typically, it's simply customer site, company site, but I've seen a few others. We're probably still stuck with one G&A, but look what we can do with those structures here in just a minute. In order to do the example, I need to talk about a wrap rate. So what's a wrap rate? Most of you are probably familiar with a wrap rate. It's shorthand for if I have $1 worth of labor, what do I have to sell it for to get all my costs back? And here's the example. If I had a fringe rate of 28% and an overhead of 50, remember that's a 78% total add there, and a G&A on a total cost input basis of 15%, then I take the $1, I add 28 cents for fringes and 50 cents for my overhead. I take a subtotal and I add another 15%. for my G&A and I get $2.05, my wrap rate is 2.05. So every dollar of labor that I incur, I have to sell for $2.05 to break even. Now remember, there's no profit in there yet. That's just to break even. And in reality, for most government contractors, the wrap rate is still not break even because there are some costs that are unallowable and they aren't included in any of those pools. We already mentioned a couple of them. There's federal income taxes, there's legal costs. Certain legal costs are not allowable. Interest expense is not allowable. Alcoholic beverages are not allowable. Excess travel costs, over per diem or first class travel, those kinds of things are not allowable. So you have to take those things into consideration as well. And they usually run between 5 and 10%. So it's probably more like 210 or 215 to break even, including the unallowables. That's a wrap rate. So why a wrap rate? Because it helps me measure things easily. This rate structure is one that I actually used at a company I work for, let's just say several years ago, because I don't want to tell you how long ago it was. We had 3 different fringe rates. We had a full fringe for our typical employees. We had a reduced fringe because we did a fair amount of work around naval bases up in the Northeast, around Groton, Connecticut, and Newport News, Rhode Island. We had a minimum fringe rate for occasional labor, like part-timers. It was basically just payroll taxes and a little bit of other stuff. When it came to our overheads, we had a little bit of a unique structure. We had major metropolitan area offices. We're talking about offices like in New York City, downtown San Francisco, downtown Washington, D.C. Those are very expensive places. And the occupancy cost tends to drive those overhead rates very high. But we had field offices in places like Fort Rucker, Alabama, Fort Huachuca, Arizona, Fort Sill, Oklahoma. And those are very inexpensive places to rent space. And so the occupancy costs tend to be very low. And then we had a customer site rate for when the customer was furnishing the heat and lights and the water and so forth. And that rate was around 12%. Look at the chart there and the different wrap rates you could get by combining those rates. If you were working in a major metropolitan area and you were using employees that got full fringe, the wrap was 2.6. In today's environment, I probably couldn't win much of anything with a 2.6 wrap rate. But look at the customer site. When I used employees that were occasional labor or part-timers at a 14% fringe, my wrap rate was 1.45, less than 1.5. I could win with that all day long. Problem is I can't do all the work that I need to do with those employees on customer site. So somewhere in between in there, I could get a wrap rate that was something I could win with and something I could perform with somewhere in that matrix. And that structure served the company very, very well for a number of years. So why make it complicated? Because sometimes you have to get the rate structure you need. So what rate structure do you need? When you go about developing rates, the first thing you do is pick a structure, okay? It doesn't do any good to start pooling cost until you know what kind of structure you want. And I'm asked all the time, what is the right structure for indirect cost? And the answer is, it's the structure that allows you to recover all your cost and still let you win. Because recovering all your costs is great, but if you can't win anything, it doesn't do any good. And winning is great, but if you aren't recovering all your costs, let me tell you, you can't make that up on volume, okay? You have to recover all your costs. Some pretty general advice. There's a good reason to stay in the mainstream because you want the auditors to understand and like the system you're using. So stay in the mainstream if there's, unless there's a really good reason to deviate from it. Don't complicate unnecessarily, and don't go with really small pools, because really small pools can be very volatile and can cause your rate to fluctuate dramatically. Now, very small pools are also going to have very small variances in dollars, but the danger there is that DCAA, when they're examining a big proposal you've just submitted, will come in and look at your actuals, and that 5% customer site rate, which is a tiny little pool, for one reason or another is showing actuals year to date. And remember, we're only in the first week of February, so year to date might not be realistic, but still, if the actuals are 25%, they're going to go back to the office and write an audit report on that proposal that says 5% isn't realistic. The company is currently experiencing 25%, and you can get evaluated right out of the running for that proposal. So keep your pools large enough to be stable, and pick a structure with enough flexibility that you can live with it for a while, because you don't want to change your structure every single year. Keep it consistent as long as you can. So once you've decided what your structure is and what your pools are going to be, you start pooling your cost and calculating your rates on a pro forma basis. You're supposed to do that every year, at least 90 days before the years start. By the way, I don't know anybody that makes that 90-day deadline. I have a few companies I've talked to in the last year that say they do, but it's problematic. It's hard to do that. You can get a basic layout of elements by pool online in a number of different places. DCAA has a good one in their information for contractors booklet that's on their website. National Institutes of Health and the Centers for Medicare and Medicaid Services have some unusual rules about how they look at indirect cost. And if those are your primary customer, one of those, then you might consider using a pool structure from one of them. Stick with the recommended elements for your customer, okay? And don't try to reinvent the wheel. If your primary agency or your primary customer has a preferred calculation model, use that one. Go to them and ask them what their pro forma model is for rates, if you're developing, particularly if you're developing rates for the first time. And if it doesn't fit the structure of the pool elements you've chosen, make sure you understand why and can explain it to them. By the way, plagiarism is terrible in journalism. It's not considered good form in literature. It's completely acceptable in government contracting, so don't reinvent the wheel. Get a model from a friend in another company that they've used and they know works, and DCAA has accepted it, and use it. And if you're really out there on your own, get help with the first one or two. Chances are your CPA firm has helped other customers with rate models, and they can help you with yours. There are a few trends going on out there that I'd like to talk about just very briefly. There is a distinct trend toward multiple fringe rates. I've seen companies with multiple fringe rates more probably in the last 2 years than in the last 20. I've seen a few companies with as many as 3. Now, I did create a 3 fringe pool structure for that company I worked for a number of years ago, but that was a fairly large company, and it wasn't unusual in those days to see multiple fringe pools in large companies. But I'm seeing multiple fringe pools today in companies as small as 50 or 100 employees. Despite that trend, I am seeing a few companies that are consolidating duplicative pools to make the pools larger and a little less volatile. And by the way, that's not always a voluntary thing. I see DCAA sometimes look at a company's rate structure and they compare the rates in 3 different pools that are 0.1% apart, and they come back to the company and say, why are these separate pools? They're all giving you the same rate. You know, we don't want to deal with the complexity. you would probably better served without the complexity as well. I am seeing some fringe pools based on geography, and we can thank the healthcare cost for that. They tend to be regional and they tend to vary significantly. We are also seeing some gradation between pools based on cost other than just company or customer site. Again, geography has a lot to do with it. We've seen that before. Sometimes other kinds of factors like lines of business. Some agencies tend to demand that some kinds of costs be indirect more than direct. They won't pay for them direct. And of course, you can't put them in the overhead just because the company won't pay, the agency won't pay for them direct. So we do see companies with overhead rates sometimes by division because the divisions work for different customers. There is a distinct trend away from including fringe in the overhead base. I promised you we would talk about that in a future webinar, and we will. This can cause a distortion, and it's one of the things DCAA is looking for in their examinations of rates this year. So, last poll, I promise, and it's an easy yes or no. Is fringe in your overhead base? So when you apply overhead, is it on labor plus fringe, or is it just labor? Very quickly, Jess, what are we seeing?
Sure, no problem. Let's see here. We have 57% said yes, and 43% said no.
Oh, not too bad. It's roughly 50-50.
Not bad at all.
Interesting. Okay, thank you very much for your patience with these polls. It does help us understand how the companies we work with are doing things. Just a couple glimpses at some of the things we do in Unanet. Our software calculates indirect rates for our clients. We let you have as many different rate pools as you would like. You can do different pool structures for different years. These all have the same structure, but of course the rates are different from year to year, but you can also have different structures from year to year. The statement of indirect expenses is calculated by the system, printed out or displayed by the system, and it gives an auditor or a manager for that matter, everything you need to see in one screen about how your rates are calculated and what's driving the rates in different places. And then, of course, when we do job status reports, those calculated rates, whether they're actuals or provisional rates or target rates, can be applied to the direct cost and rolled up into your total cost. Finally, these are some of the results from last year's survey. The survey is called Gauge. We conducted the first Gauge survey this past year with our partner Cone Resnick, and we will be doing a Gauge survey again this year. In fact, I took a look at the survey instrument last week, and that should go out very shortly. I hope you'll participate in that survey. It lets us see what's going on out there in the industry, and we're hoping it will help us track trends in what we're doing. The survey itself is available to everyone who participates in helping us gather the data. So if you respond to the Gauge survey, you will automatically get a copy of the Gauge report when it comes out next year. I think the survey is going to be open, yes, until late April this year, and should take no more than 30 minutes. It's absolutely confidential. That said, there are sections of the survey that some companies are not comfortable with responding to, and you can simply skip those if you choose. I hope you took a little something away from this. I have found that even companies that have been doing rates for a long, long time will sometimes find a new little tidbit in one of these webinars. I hope you did. Please feel free to get in touch if you have questions or if there's something else you'd like to know about rates. And watch for our next one.